Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello, this is Gary Wilson, your host for the Massive Passive Cash Flow podcast. Welcome aboard. Glad to have you back again. If you haven't already done so, please feel free to subscribe to the podcast. It's on Stitcher, iTunes, iHeartRadio, and a total of 30 different channels. So take your pick. By the way, something new, if you haven't already, go to realestatewithgarywilson.com. Up top, you'll see the menu bar. Click on the word members area, the term members area. Log in. If you're a member, you know what to do. You log in on the left. If you're not a member, go to the right. And we're going to let you have a free peek for 30 days to get all the material. Literally access to the books, all kinds of stuff, calculators, spreadsheets, over 300 webinars recorded on 1031 exchange, buying within self-directed IRA. It's just a wealth of information that you get to grab like Christmas time for free. So I suggest you do that. But the big reason is this. All those agents we've been training over all the years, they're certified investor agents. We know who they are because we train them. It's the only place they can get this certification. And it's now kind of halfway across. We're literally in half the states in the country, in the U.S., okay, even in Canada, 3 Canadian provinces. The reason this is so important is we're all investors. We created that because most residential agents were not really trained to work with us. The commercial guys are, but they don't want to deal with fourplexes and duplexes and flips, okay? So grab yourself one of the investor agents, right? They're almost everywhere you want to invest. And that doesn't cost you anything either. So grab them. They're trained to work with you and me. They know what they're doing. They have access to all the research tools, the actual leads. Every property in the country, they have access to property information and owner information, including loan balances, just an amazing amount of information. So in any case, have at it, have it all for free, and we're glad to do it. So back to today. We got Cameron and Anthony on board here. Okay, we're going to talk about some financial planning with a little bit of a twist here. It's not the normal stuff you're used to. So Anthony and Cameron, welcome aboard, guys.
Thanks for the invite, Gary. And what a great offer you just threw down there. That's I hope a lot of people will take advantage of that.
That's some value right there. Thanks for having us, Gary.
Yeah, you're welcome. Hey, I guess I tell you what, I want to thank you for taking your time because I know you're both successful and you're busy because you're successful. And I know this is valuable time, so I know we're blessed to be able to have you. But if you wouldn't mind, I know you're two pretty cool guys because I read everything about you. Would you mind just painting a picture for us? Just give us the straight scoop, even if it's stuff that maybe your parents will get you in trouble for,
The straight scoop, just a kind of a history on myself. Is that what you're asking, Gary?
Yeah. How you got to where you are today, and then we'll dig into some meat and potatoes.
Okay, good. Because I was actually thinking of childhood stories where I could get in trouble, but we'll leave those alone. How I ended up here in this position was I'm originally from North Idaho. I grew up in the country, and I moved to Las Vegas about 16 years ago. And when I moved to town, I actually started a small business. And I had that for several years, and it was in that really got me interested in personal finance. I was looking for retirement options for myself. I was self-employed, and I didn't have an HR department to turn to. And so what I ended up doing is I ended up kind of researching on my own. Mm-hmm. And what happened pretty quickly, Gary, was I got overwhelmed and frustrated. Yeah. And so I didn't do anything, to be honest. I just sat on cash. And the message that I had received at that time from advisors was essentially give me your money and come back for it when you're 60 years old. And as a small business owner, that never sat well with me. Yeah. And so what ended up happening, kind of fast forward, is I came across a strategy that worked really well for my situation. And I started implementing it personally and then also for my business. And I started sharing that strategy with other business owners that I knew. And that helped alleviate some of my cash flow issues at certain times of the year. And so that is how I ended up kind of getting into this business. Once I started practicing this, I almost felt an obligation to go and share it with other owners that I knew. And about 10 years ago, I ended up meeting this guy. And so we worked at an old firm together. And then 2 years ago, we actually ventured off on our own and started Infinite Wealth Consultants.
Cool.
Now, Gary, I'm born and raised in Las Vegas, went in the Army right out of high school, then got a degree in accounting and became a CPA, eventually had my own firm. And I thought I had it all figured out, right? I thought I was a business owner, but really I just owned my own job, right? If I wasn't in there, if I wasn't working, I wasn't making money, right? And then 08 happened, right? And Las Vegas got hit really hard. But the thing that really hit me is I saw these clients that would come in, some literally in tears, saying, Anthony, I did everything you and my financial planner told me to do. I maxed out my 401k. You know, I stayed out of debt. I paid off my house, right? And then now my 401k is a 201k. Yeah. And equity in my house is gone. And I'm supposed to go. This guy individually was retired. I'm like, man, you're going to have to go back to work. He's like, I'm in my 60s. Unemployment is in double digits. Like, who's going to hire me? And I got sad for that individual. But then when I went home, I was telling my wife, I'm like, you know what? We're on the same track this guy's doing. He's following the same advice we are. And I started doing my research, and you know what? There is a quote unquote correction about every 10 years. I mean, this 08 was bad, and there was one in 2000, the 90s, the 80s, the 70s. And I'm like, you know what? If I don't do anything different, why would I expect a different result? Right. So I started looking for myself selfishly, like, what am I going to do for my family? And I noticed, even though most of my clients got punched in the gut, there was a small few that actually did very well during that time. They were the ones buying your neighbor's house for 50 cents on the dollar, right? They were expanding their business when everybody was contracting. And so I approached them like, what are you doing? And more importantly, like, what's your mindset? What books are you reading? How did you prepare for this? You know, what are you doing differently? And so they pointed me into some books, and I started reading, and I started following what they were doing. And then my tax clients was like, hey, Anthony, I don't trust Wall Street. What should I do? I'm like, well, here's what I'm doing, you know, and particularly, you know, promoting Rich Dad, Poor Dad, right? Typical financial advice is, let's build up your net worth, right? Don't touch it till you're old. But, you know, but then hopefully it's going to be there. But Robert Kiyosaki's like, whoa, don't focus on net worth, focus on passive income. Then you get your passive income more than your monthly expenses. You don't have to wait till you're old. You can start enjoying your life then. And I had young kids, and I wanted to be around. So I started teaching people these concepts. And then eventually, you know, I had 2 businesses, and I personally, I believe you can't be an expert in multiple areas. And I wanted to be an expert in my sandbox. So the choice was easy. I sold my firm probably about 6 years ago, and been doing more kind of teaching people to create passive income outside of Wall Street for the last 10 years. And then Cameron and I just have the same value system, and we get along well. So we joined forces, and here we are. Awesome.
That's a great introduction. And you mentioned a couple of key things. I took Robert Kiyosaki's program way back in the late 90s. You know, he was pretty much just getting started. And I read every single book he either wrote, or Sharon Lecter. I met her too. She's the one that actually did a lot of the writing. And then all these other books he let other people write using the brand. I read all those too. And I actually met him. He came to my mastermind group about 5-6 years ago. Holy smokes. I got to spend a day with him, have dinner with him. And I'm telling him, I say, look, you know, I did everything, you know, the cash flow quadrant, right? I went from being employee to self-employed to investor, and investor to business builder. And I said, I thought the investing was the end game, but it turns out it's really, I'm making more money from the businesses I'm building, but I wouldn't have built the businesses if I didn't have a foundation of a lot of real estate. And he said, you got to figure out, he said, that's exactly right. He said, a lot of people misunderstand. They think that the investing is the end game. It's really providing you the platform, the foundation upon which you can do other things you really love and build other businesses. And you'll make a lot of money building businesses and selling them and doing all kinds of stuff. It's an amazing phenomenon, if you will. But so in any case, I also love the game. So we have what's called Global Investor Group. It's a network of investor clubs around the country. GIG is the term. Gig. We got a new gig in town, right? So part of it is we play cash flow, and it's amazing. People, when they realize how the game works, I'm like, well, that's how it works in life too. And we have this thing, and whenever you have a big win in the game, like you buy stock for $1 and you sell it for $40, then you jump up and down and you yell hallelujah. So this whole room, like every 10 minutes, people are jumping hallelujah. So it's an amazing thing to witness. But in any case, so back to this. What I want to do is I appreciate that introduction and background, because it paints a picture for us. And what I want to find out is what are the top 3 things you discovered that are wrong, flat wrong about the old financial planning model of, build that 401k and then when you retire, set for life. And, because I can think of a number of them, but I want to hear from your perspective. You've actually lived it, and it's more valuable. So what are the would you say the top 3? Maybe there's 5, maybe there's 10, but what are the top 3?
Well, let's start with qualified plans or 401ks or IRAs. I was taught, and I used to tell people, hey, let's max this out, because let's get that tax deduction today, because you're going to be in a lower tax bracket when you retire. Mm-hmm. And I found firsthand of doing people's taxes that for successful people, that typically just ain't so. Yeah. And what I tell people is like, what are your 2 biggest tax deductions? I mean, for most people, it's a mortgage interest and their kids, right? So let's fast forward till you're in retirement. You know what? Even if those kids are still living off you can't deduct them anymore. Right? Yeah. And most of the time, the plan is that mortgage might be paid off or at least paid down. Mm-hmm. So the problem is we're losing our 2 biggest tax deductions. Mm-hmm. And then, we take the money from our 401k. Well, that's taxable. And if we have a spouse, she's doing the same, right? Mm-hmm. And then the Social Security is taxable. And if you're doing and we do try to promote people not to just, when they retire, let's do something. Let's not just stay at home in the rocking chair and watch Family Feud. Like, now let's do something that you want to do. You don't have to rely on a paycheck, but you get that paycheck from doing what you want to do. That's going to be taxable. So the problem is, and that's also assuming tax rates stay the same. I mean, we are giving away literally trillions of dollars. Yeah. At some point, we're going to have to pay the piper. And
you mean that money's not free? We got it.
Yeah.
It was free. I mean, I'm wanting to get more of that money. No, I'm just kidding. Go ahead.
Yeah. And, and then it relates to is really what are your goals?
Yeah.
Right. If you're happy at your job and you don't mind waiting until you're 59 and a half and start drawing from it, all the power to you. But if you really dig deep, and maybe people don't even know it's possible, right? Maybe they haven't heard of passive income, but you start explaining that to them like, well, okay, well, I want to create some passive income. Well, your 401k is not a great tool to do that. So that to me would probably be the biggest one misconception. What would you add, Cameron?
Yeah, a misconception that comes to mind is more risk, more reward. I think that's probably one of the biggest misconceptions out there. Everybody thinks you need to risk a lot or take a lot of risk and to create a lot of wealth, and that's really not the case. Yeah. In reality, what you're going to find is if you look at some of the wealthiest people is they do 2 things. Number one is they retain control over their money. And then number two is they also have some guarantees or some consistency that comes along with that. And so when you start talking to people, especially, people that are in business or built businesses or real estate, there's kind of a process that they follow, right? It's, hey, I know that if I do A and B, then there's a very high likelihood that C is going to happen. And that is it. That is investing, right? That is control. That's predictability. That's consistency. Those are guarantees. And that's, in our opinion, that's how you create wealth. You go get really, really good at something, and then you duplicate it, and you go over and you do it again, and you do it again, and you do it again, right? And so that's probably a big misconception is people think, right, that you've got to chase these high reward and high risk situations. And really at the end of the day, what it comes down to is there's a lack of understanding on the difference between saving and investing, and even speculating, right? Those three words are often used interchangeably in our industry. And the way that I typically describe that, or the difference between the three of them, is that saving is the act, right? There's a savings as far as a nest egg goes, but it's an act. You're moving money from one account to the next each month, right? For the investing there's a level of due diligence that you're putting into this opportunity before you ever put money into it, right? Whether it's getting educated on it, understanding how this works. It's that A plus B equals C process. That's investing. And then speculating is really where you're just kind of on a hope and a prayer, right? You're hoping that it's going to be of greater value when you're want to sell it than what you bought it for today. So that would be what I'd share there as far as number two.
Okay.
And then a third one would be is that we're getting too passive with our own money.
Good one.
We just say, okay. And I would tell you, I even did it myself. I was like, I thought I could manage the money in my mutual funds. And then when I got a financial advisor, I'm like, well, they're charging me 1%. Odds are they should be able to do 1% more than me. So what I did is I outsourced my finances. And I mean, here's a prime example. In 2008, my son lost 60% of his 529 plan. Okay. Yeah. He was going to school in 2 years. So it's not like he's 5 and the financial advisor, oh, well, he's got time on his side and it'll come back up. We didn't have time on our side. And what I told him, I said, well, actually, and my daughter, she only lost 50%. Okay. Yeah. But the thing was, I called up my financial plan. I'm like, wait a minute. I thought this was on, I don't know what they call it, like an age-based, where the older they get, the more conservative it gets to make sure the money's going to be there. But he's like, we did check that box. I'm like, well, then why did my son lose more than my daughter who's younger? He's like, oh, you know what? We didn't check that box. Oh. And I'm like, you know what? That's when I realized, you know what? Nobody's going to care more about my money than me. And if I want to achieve the goals that I want, I can't give up that control. I need to start having control. And a lot of people now, we're just taught to be passive. Let's just trust the financial advisor. And I think most advisors are good and ethical, but the resources or tools that they have are limited. It's not about passive income. Like you go to Merrill Lynch or one of these big houses, they're not going to promote buying a rental property.
Right.
I mean, but what they will promote is a REIT, right? Because that's something that they sell. Right. But they're not going to help you achieve financial freedom. They're going to try to grow your net worth. And just kind of as we're talking, I mean, we want to create passive income. And so your typical financial planner is not going to get that done. Yeah.
Yeah, I agree. It's funny you mentioned the control part. So one of the premises I learned from Kiyosaki is, when you're growing, it's okay to give up responsibility, but never give up control. It's two different things, So any case, I appreciate that. So you mentioned real estate. I know in the past, this is really such an interesting podcast because in the past, financial planners were definitely, in the world of stocks, bonds, and mutual funds, and not real estate. And real estate people were not in the world of stocks, bonds, and mutual funds. But I was always one of the guys that actually did both. And I did stocks, bonds, and mutual funds before I did real estate, and did well. I was beating the averages, and I'm not a genius. It's just when on my lunch break, I was working in banking. I ended up doing mergers and acquisitions. And at lunchtime, I would go up to the corporate library with my brown bag lunch because I'm Mr. Frugal, and I would study, the Lone Star, not Lone Star, the Morningstar ratings. I read Barron's and Forbes and Fortune, and get all the periodicals and read all these prospectuses and read the annual reports of these companies. And I realized, I think, you know what? The secret is not in how well they've been performing. The secret is who's managing. And I started tracking management, and that's why I was able to do so well. But anyways, fast forward, get into real estate, and I realized the big difference was real estate gave me that physical, tangible asset that's generating revenue. And then people would say, well, you could have a stock that generates dividends as well as growth and value to it. I said, well, I understand that. But the thing is a company can go out of business and a stock can go to zero. A piece of land, I don't think is ever in history of the world has ever gone to zero,
Yeah.
So let's talk about the real estate for a moment. How do you view, like, there's all these techniques out there, all the creative purchasing techniques. People are wholesaling, doing wraparound mortgages, blanket mortgages, owner financing, no money down, all this kind of stuff. Then you got people who will get to a cash basis and like to pay cash, but then later on they'll refinance and pull their money out. They'll get the good deal first, raise the rents, raise the value, and then get a new loan and pull the money out and replenish their capital. So there's like dozens of strategies. But what's your philosophy on when you purchase real estate? The people who like to use cash versus the people who don't like to use any of their money at all. It's like a wide, total opposite end of the spectrum. So.
That's a good one.
Yeah,
that's loaded for us. Yeah,
that's right up our alley.
Yeah.
So we're fighting over who can answer it.
Go ahead. I'll jump in.
Okay. Well, typically, because you mentioned a couple different types: wholesaling, buy and hold, or the burst strategy. Our philosophy, they all work. I mean, there's no one way to build wealth.
Mm-hmm.
What you need to find is something that you're passionate about and that you understand.
Yeah.
And so if that's wholesaling, great. Or if it's a burst strategy, great. But a lot of people don't have the time or the experience to do the burst strategy. Well, then there's turnkey rentals, or you work with a realtor who knows their stuff, right? Who knows about investment properties, because buying investment property is very different than buying your primary home, right? So you need to work with a team. But I would, ideally, we're big fans of leverage, which is, I mean, there's so many great things about real estate, right? Because you were comparing it to a dividend, but it's difficult to leverage stock. Yeah. Right. But you can put 20% down and control 100% of the asset.
Mm-hmm.
So then that appreciation is on 100%, not on what you put on. And then also the tax advantages of real estate is really one of the best tax favored assets that I am aware of. We get that tax deduction, and any gain is taxed at the lowest rate, which is a capital gains rate. We could talk all day about what the advantages, what we like about real estate, but your question, or part of it was, well, maybe the bigger one is, well, how do we finance it? Right. Mm-hmm. Now, if we can use other people's money, that's awesome. Right. As long as, that does include a risk. So we got to make sure if we're using a hard money loan or using a loan, and we don't, a tenant doesn't pay rent, like we got to make sure we have some reserves. But if you can have those reserves and be prepared, leverage is the way to go. But a lot of times they want you to have skin in the game. Yeah. Right. And typically with a lot of our clients, they're putting with these investment properties, we're putting down as least as we can. But as you know, Fannie Mae's tightening some of the rules. But if you put 20% down plus closing costs, the question gets to be is, well, what's the best way to get that 20 grand?
Yeah.
And the problem with cash, whether you're paying the down payment or you're paying the whole thing, is you buy the asset and drain your account.
Yeah.
Okay. So now you have the asset, but you don't have any money.
Yeah.
But then you want to buy another asset. So we save up a little bit of cash till we can buy asset number 2. Then we drain our account. The problem is, Gary, is we're breaking the compound interest curve. We save up money and drain our account. So kind of what we teach is called the infinite banking concept. And we want people to buy real estate. And we're not saying you do infinite banking or real estate, but this can be an and asset. That basically what we're doing is you got to have a checking account or some sort of bank account that you store your down payment in, and then you buy the house, and then you that income has to go somewhere. So you put it back into that account. And then when you have enough, you buy a property too. So with infinite banking, and the simplest things is we're just changing where we're storing the money.
Okay.
Instead of using somebody else's bank, we're using a properly structured high cash value life insurance policy.
Okay.
And nothing to do with death benefit. And I like to say that this ain't your mama's whole life insurance.
Okay.
Right. This is designed very different, and it's designed to maximize cash. And you know what? The death benefit, just ice on the cake, right?
Yeah.
What we're looking for is a safe place to store our money that's liquid, that's safe. And typically you can accomplish that by using a bank account.
Yeah.
But with using these types of policies, in addition to being safe and liquid, it's also asset protected, and it's going to grow at a higher rate of return than a bank account. And more importantly is we can leverage against that. And in essence, what that means is we never draw the money from your account. We never break that compound interest curve. You just continue to buy your assets, and your bank account, instead of being drained and building back up, it just goes up a little bit each year.
Yeah. What I would add there is that when you look at somebody that's created wealth over one lifetime, almost always it includes business and or real estate.
Yeah.
And it's because of that ability to leverage. And so what we're doing is we're just showing people one of the biggest pitfalls that is out there in personal finance is that cash approach, is spending that cash and giving up that compounding of it. I mean, you talk to any real estate investor and, you know, you've got kind of 2 point of views, either cash is king or cash is trash. And cash is king, right? As everybody knows, because as an investor, man, you got to have cash available to you because, man, those once in a lifetime deals only come by once in a lifetime, right? Yeah. And then the other side on the cash is trash is that, man, you really don't want cash sitting in a savings account, checking account, because it's getting eaten by inflation. And so by using those types of accounts that Anthony just described is, man, you know what? We're able to satisfy both of those needs right there.
Yeah. Now, I love the approach. So really what you're doing is you're purchasing a whole life policy that, again, does have a death benefit. And I guess I should preface this with this. When I was growing up in the world of building businesses and buying real estate, I was blessed to be able to become friends with a lot of super affluent, wealthy people. And almost all of them had a big, giant whole life policy. And they said one of the reasons was often they built their own business, and like they were the head of their business. And if they get hit by the proverbial bus, their business would lose value overnight. Like it's not the same business. Yeah. Nobody's going to be like you, right? So they had this death benefit that would allow the heirs, the family, the wife and children, whatever, to maintain that lifestyle that they're used to, and in the business they could sell, and take that money and do whatever they want with it, that kind of thing. But the reality was they were using it. They were borrowing against the cash value, like you're describing there, to build or buy other businesses, or like you mentioned also, Cameron, is buying real estate. And that was one of the key things. And there's one thing I saw one time, and I know that this was typical. I don't even know the company that did it, but one of my students, his father had a large parcel of land in Alabama that he bought back in like 1962 for like, whatever, $300 or something, acreage. And now and over the years, they built a major highway through it. This was going down near Gulfport and to the coast. And then there's recently, University of Alabama, it's Auburn, is building a part of the university out there. And then they decided, okay, now we're going to build this housing community with a shopping mall and movie theaters. So all of a sudden, this land became extremely valuable. So what they did is the father, who's now in his 80s, bought a whole life policy. And the lender, the whole life insurance company, didn't just let him borrow against the cash value. They let him borrow against the death benefit and secured it with not only the cash value of the policy, but the land in Alabama. And the whole life insurance company made the loan. They didn't go to another bank. They made the loan, and they made themselves, I guess, maybe additional beneficiary on the death benefit part of the policy. So if they they hit by the bus, they get their money back, and then you're gonna get the money back anyways because it's secured by land. So I don't know if you ever heard. I don't know if that was just a unique circumstance, but I thought that's one of the coolest things I've ever heard of. It's like that idea on steroids or something. So, but any case, is that something normal, or what I just described, or would you say that was more of a unique circumstance because the whole life insurance customer also had this other valuable asset that was owned free and clear? Maybe was the different factor.
That would be a unique circumstance. Typically, they're always willing to lend against the cash value of the policy, but not the death benefit. But I'll tell you what, Gary, if you remember the name of that company, give us a call.
It was. I never heard of them before. It was probably some local. I'll find. I'm going to write that down because my old student's name is David, and I owe him a phone call. But that was pretty unique. And I'd never heard of it. I said, David, honestly, but I was his teacher. And I said, honestly, I'd never heard of that before, but it sounds pretty darn good. So any case, if you think about it from the lender's perspective, you've got a lot of security. I mean, you've got this property that's worth, a lot of money. Then you got the death benefit. So if they get hit by the bus, you're covered that way. So most loans only are collateralized with some asset, either the whole life cash balance or a traditional loan from the bank for the property. But let's talk about this this whole concept a little bit more. So infinite banking. So I mean, I guess the big picture is you can use infinite banking with a whole life policy to not only buy real estate, but what are some of the other benefits? Like I know obviously it's growing in value. So let's talk about that for a second. So if you borrow money against the cash value, is the whole policy still growing in value? And what about taxes and things like that,
Yeah, great question. So what's happening is, let me make a distinction here, is that when somebody pays a premium, is they're funding their personal policy. And you can choose how much money is going to the premiums for the cash value or premiums to build up the death benefit. And what we're doing is we're maximizing the cash value portion. And so once you get cash value inside of an insurance policy, there's going to be kind of two numbers that you want to make note of. Is you've got a guaranteed minimum of growth on the cash value portion. And then they also, because we use mutual insurance companies, is these companies will pay you a dividend. And a dividend is really just a portion of the profits at the end of the year. And so you have a guaranteed value, and then you've got dividends, which are non-guaranteed. And we typically will use the number around 4% is what your cash value is going to grow by every single year. Obviously, it's a little bit different for age and ratings and those things, but that's kind of the number. So you've got cash value that's growing at 4%. And then the key here is what we've been talking about is you don't want to take the cash out of that policy.
Yeah.
Right? You don't want to surrender it. What you want to do is you want to put that money up as collateral and take a loan against it. And so you can do that with the same insurance company that is hosting that policy, and they'll actually extend you a loan, or they'll extend you what essentially is a line of credit from the general fund of the insurance company up to the amount of your cash value.
Okay.
And so now what you're doing is you're taking a loan against your cash value from the general fund of the insurance company, and that's the money that you actually receive. And then you turn around and you go and you will deploy it to buy some sort of cash flowing asset.
Yeah.
When they extend you that line of credit, what happens is they actually will put a lien on your cash value.
Gotcha.
So it's not going anywhere. It's still in your policy, earning and compounding at 4%. It's just there's a lien, which just means that right, you can't access that portion.
Yeah. Okay.
Now, Gary, you probably have some your students using the HELOC.
Yeah.
Right, a home equity line of credit.
Yeah.
Very similar concept, right? It's a line of credit against the equity of your home, and the appreciation of your home is still yours.
Yeah.
Right. Same thing we use it with infinite banking. You're taking a loan against the equity of your policy, and that growth is still yours. But one thing that's cool, Gary, is when we use this policy for an investment purpose, we can actually create tax deductions.
Okay.
So, and when we combine it with real estate, because as I alluded to earlier, there's a lot of tax advantages of real estate, and I don't know a single asset that has better tax advantages.
Okay.
And when you combine that with infinite banking and creating those tax deductions, I think that's where we're truly maximizing the tax code.
Gotcha. Okay. All right. And by the way, I know this is real simple too, and slightly different subject, but when a whole life policy owner passes away and the death benefit kicks in to the heirs, that's also tax free, right? That money passes to the heirs tax free. So at every step of the way, I mean, going back to the old 401k, I used to have a big one. I'm thinking, I'm doing pretty good. I was in my 20s and 30s, and I realized, wait a second, the money that comes out, I have to pay taxes as I bring it out. What's the tax code going to look like in 30, 40, 50 years? I don't know. Could be better, could be worse. And then with the Roth IRA, I'm not saying people, I'm not poo-pooing all these other things. I saw that there were inherent flaws. And with the old Roth IRA, okay, well, you're putting money in that you've already paid taxes on. And certainly when you pull it out, you don't pay taxes on that thing. But at the same time, when it comes to this whole philosophy here with the whole life policy, when you can consider the fact that, any money that passes to your heirs from the death benefit's tax-free anyways, and there's no limit, there's no like an inheritance tax thing, it's just tax-free, right? Why wouldn't you plunk your money down in a whole life policy so that you can leverage those funds? So let's say, for example, I know we're getting short on time. Let's do this. We'll do this one example, then we'll wrap it up. Let's say I inherit $1 million. Okay. Can I go out and buy a whole life policy, putting in that $1 million to start with, and still add on as I want to? And does that give me immediate, like if I put it all towards cash value, because that, other than maybe the cost of doing the business, is that all accessible, or how does that work?
Well, there's a lot of different ways to design it, which is key, right? And oftentimes we have clients, particularly now, where they have this lump sum. Well, some, particularly the CARES Act, were able to take out $100,000 of their 401k, and we were able to put that single deposit into a policy, and at the end of year one, they have 98% liquidity. And then they can turn around and start using that immediately. Okay.
That's cool. Okay. Well,
I think it's totally cool, Gary, but I'm a recovering CPA, so
we're trying to play it cool right now, but we get pretty excited about it, to be honest.
Well, I'm just thinking through, there's so many positives to this, and there are really not that many. Like, to me, I have this philosophy in life. Whenever I look at a big decision, I think, okay, what's the upside potential and what's the downside risk? And I'm looking for like how much bigger is the upside potential than the downside risk, and the bigger the better. Well, clearly this is one of the ones I'm going to endorse this whole philosophy for everybody listening. I think the upside potential with this, guys, is far greater than the downside risk. And if you're a dentist out there and you're worried about being stuck behind the chair when you're 65 years old, start preparing for that using this logic, and you can use your capital, deploy it. You're making money on already with a guaranteed minimum, and now you can buy an income producing asset at the same time, borrowing against something that's already yours, right? So it's probably far fewer costs than borrowing the money. You know, you probably have more flexibility in the loan terms, much better than easier than working with a bank. I'm not the bankers. I used to be a banker. I'm just telling you, this is honest. Yeah, that's right. This is a bona fide, honest to goodness, true, you know, full of upside potential opportunity for everybody out there to take advantage. And it doesn't have to be ultra wealthy. It can be regular folks, you know. So, any case, if we could do this, guys, how can people get a hold of you? I mean, this has been one of the best podcasts. This has been an awesome podcast, by the way. Yeah, go ahead.
Thanks, Gary. And you know what? There's pros and cons, upside and downside to doing everything, and infinite banking is no exception, right? So when we meet with a client, we're very clear, right? Here's some obstacles, here's some downside, and here's the upside. Our kind of view is educating the client, and so if they know all the ins and outs, then they're in a position to make the best decision for their family. So a couple ways to get a hold of us is we can give you a link to put in the show notes. What we call is a discovery call. It's about 15 to 30 minutes where we're just really going to talk about your goals and kind of what you're trying to accomplish to try to see if we can help you achieve your goals faster and with more certainty.
Yeah.
And then if it is, then we start explaining how this works and how this could benefit the individual. Gary, we're big on education. So we do have an online course, which I don't know what we're charging for it now. As
it's right now, I think we're at $600.
We're about $600. But what we'd like to do for your listeners, Gary, is we'll give you a link and they can get free access to the course.
Okay.
And when they get access to the course, we're not going to start chasing them, right? Because our deal is, look, once you learn about this, if you want to do it, we'd hope that we would have earned your business, right? And if you don't want to do it, then the last thing we want to do is start chasing people.
Yeah.
So Cameron, what's the URL?
Yep. It's going to be infinitewealthconsultants.com.
Okay.
/Gary Wilson.
Gotcha. Okay.
And that'll take them to a landing page, and then they'll get access to the course.
Okay. So everybody listening, infinitewealthconsultants.com /Gary Wilson. And we'll put that in the show notes too. And I see your emails, obviously the website's there. So in any case, this is pretty awesome, guys. I appreciate it. I think that's probably one of the best things you can do to serve your fellow man is just to give them that free consultation. Everybody should take advantage of that. So in any case, guys, I can't thank you enough again, Cameron and Anthony, for taking your valuable time to do this. This has been a phenomenal podcast. I want to have you back on again.
We would be honored.
We'd love to.
Yeah.
And Gary, we also have a podcast.
Okay.
The Infinite Wealth Podcast, and we'd love to have you on as well.
Yeah, I'd be glad to. I've done a lot over the years. I'm 107 years old. I know it doesn't look that way, but I'm just kidding. When I bought my first house, literally the month I graduated from college, and a house hacked it. And my college roommate's name was Socrates. His dad was a Greek immigrant, and showed us how to do that. And I just, from that point on, I was hooked. I'm like, you know what? I'm gonna do the college thing and take advantage of the degree, but I couldn't wait to get out of it and be an entrepreneur. So for everybody listening, I think I speak for a lot of people, guys, for when I say thank you from the bottom of our hearts. And from both of you and everybody, all the listeners, God bless you and your families. Take care of yourselves. We'll see you on the next podcast. And in the meantime, go to the website, right? infinitewealthconsultants.com. Okay. And also when you're going to browse the websites, go to the realestateWithGaryWilson.com. Check out the investor agents. Grab yourself a certified, trained investor agent who understands how to identify, access, and then analyze properties for you. And it doesn't cost you a dime. Just go in the members area and check it all out. And if you haven't subscribed to the podcast, please feel free to do so. All right. And by the way, check out the Infinite Wealth Podcast while you're at it. Okay. And give those guys a big 5-star review. So especially the one I'm on, give that one a 6. Okay, guys, so we're going to wrap this up. We'll see you next time.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.